Alright guys, good afternoon, good evening. So wherever you're watching this video from. So this is Principles of Accounts Part 2 2023 internal. So we're going to go through this paper. We're going to solve all the question apart from the section B part and the 3A question. So let's just jump into it straight. So question 1 reads, state the source documents to be used in each of the following transaction. The first one is the secretary. The secretary for managing director bought 6 boxes of envelopes at 800 for office use. So for the first one, just the mentioning of the same envelopes. Just know that when they mention something like envelopes, stationery, uh, let's put bus, like bus fees. Just know all that will fall under the source document or the book of what is prime entry that we're going to use here is the petty cash book, and the source document for the petty cash book is the petty cash voucher. So I'll just simplify it. Number 1A, which is I. So for the first one, it will be petty cash, petty cash voucher. Yeah. So for the first one, it's petty cash voucher. Then we go on to the second one, which reads: a supplier received good returned by the customer worth 2,000, which were of wrong size and wrong count. So for this one, the book of prime entry that's actually involving this transaction is actually this is the sales returns day book, and the source document for the sales returns day book is a duplicate credit note. Duplicate credit note. Then we head on to the third one. The third one reads: payments to the supplier 3,600 was entered in the cash book, and then in brackets bank column. So this one is very easy. Is the book of prime entry that you're actually going to use here is the cash book, but the source document that we use for the cash book, you can either put a check, a receipt. So I'll actually go for the check. And then the last one for number 1A, Monster traders bought goods from their creditors, JB Peter wholesaler or resale. So for this one, the Monster traders bought goods from their creditors. So this one, you just have to know that they're buying goods from their creditors. So on the book of prime entry that's actually used here, this is the purchases day book. The source document for the purchases day book is actually this is the original invoice. Original invoice. Then we head on to B. So B reads: the following transaction are from the customer of Mwizi from November 2022. Then we have the following details: the following transactions taking place. Then we're required prepare Mwizi's sales returns day book for the month of November 2022. So we jump straight into it. First, open up our column, our bank column. So the columns. And then the date column. So now you just start it. So your first column will be for the date. The second one will be for the details. Then the third one, the folio. In here you have this is what we're going to have: invoice number. Then in here you have invoice amount. Since of course we're preparing the sales returns day book, so it's going to not be invoice, sorry about that. It's actually going to be credit number. Since the source document for the returns day book, the sales returns day book is duplicate credit note, so that's why this credit will come from credit number, credit amount, and then in the final one you'll have total amount. So we start. Everything took place in the year of 2022. The first transaction took place in November, abbreviated as NOV, on the 10th, and we have a name of teaser. So teaser retained goods for 4,500 less 10% trade discount, damage transit. So you put retained goods, and then you write the amount in the credit amount. So the retained goods costed you 4,500. Then there's also a trade discount. Then from there, how you find the trade discount? You say 4,500 multiplied by 10 divided by 100, which will give you 450. Then you subtract 4,450 from 4,500. 4,500 minus 450, which is going to give you 4,050. This amount, the 4,050, since the transactions are done, will go to the total amount. For November 10, it's done, 4,050. Then now we head on to November 16. So November 16 we have Zimba. So for November 16 reads Zimba, because of wrong color, retained 8 chitenge dresses at 400 each. So we write Zimba, so wrong color chitenge retained. So these dresses costed a total of 400. And there's no any discount, so just like that you can take the 400. Let's see. This one reads Zimba, because of wrong color, retained 8 chitenge dresses of 400 each. Sorry, because of this amount which says each, meaning it's actually not what's supposed to be 400 here. What we were supposed to do was say 8 multiplied by 400, which will give you 3,200. So here the credit amount was supposed to be 3,200. Then you bring it here as well, 3,200. Then from there we head on to November 20. November 20 we have Sidazi. So retain the following for Sidazi. There are actually a lot. There's 10 bales of sugar at 500 each. So what you do is just say 10 times 500, since it's each, which will give you 5,000. Then 15 bales of girl socks going at 150. So what you do is say so you say 15 multiplied by 150, which will give you 2,250. So 2,250. Then you head down. The next one said all subjected to a 15% trade discount. So first, before you go to the trade discount, you add up the two. 5,000 plus 2,250, which apparently will give you 7,250. And from there, below you write trade discount. So the trade discount, the total, the 7,250, which is right here, you multiply it plus the trade discount you've been given, which is 15%. So multiply it by 15 divided by 100, which will give you a total of this is 1,087.5. So you subtract 7,250 minus 1,087.5. which will give you a total of 61. This is 6,162.5. Then from there you go to the last date of November, which is November 30. Then you write transfer to sales account. Sorry, all this was actually supposed to be here. November 30, transfer to sales account. So you add up the total of everything, which is 4,050 plus 3,200 plus 6,162.5, which will give you a total of, this is 134,000, sorry, 13,412.5, and that's how you declare. Sorry, forgot to also involve the title. So the title for the sales ledger, this one, it's actually going to be Mwizi's sales return day book. That's how this one is actually going to be done. And just like that, you can close up the account for this one. Then next, we're going to now head on to the trial balance. So the trial balance that actually came in 2023, the following trial balance was prepared from an experienced bookkeeper for Chilekwa and failed to balance. So while there's these transactions that took place, then are required to redraft the trial balance correctly for Chilekwa as at 31st December 2022. So we start the solving for this one. We first start off by drawing So we start with the title. We'll have Chilekwa's trial balance as at 31st December 2022. We have the date column, we have details, we have debit, we have credit. So now we start. Capital in the trial balance is credited, which is 40,500. We have the sales are also credited, which is 34,350. Then we have purchases. The purchases are debited, which is 25,530. Then we have the drawings. The drawings are expenses in the trial balance. So drawings 500, which is also debited. Then we have loan from Zanaco. Loan is a long-term liability, so it's actually credited, which is 16,000. Then we have credit. Credit is actually credited just from the name, which is 9,000. Then we have cash in hand, sorry. So cash in hand is going at 19,320, which is debited. Then we have cash at bank. Cash at bank is going at 22,000. Then we have stock. Stock is also debited. It's an asset. which is going at 11,000. Then we have land and building. Land and building is also an asset, which is also credited. Then we have bad debts. Bad debts are also expenses, so they're actually debited. Then we have carried inwards. Carried inwards, we also debit it, which is 350. Carried outwards, that's an expense, so we're going to debit it, which is 800. Then we have purchases returns. Purchases returns, which is 250. Sorry, purchases returns are actually credited 250. So now we add up the total. So I'll start with the debit side. We have 25,530 plus 500 plus 19,320 plus 22,000 plus 11,000 plus 20,000 plus 600 plus 350 plus 800 plus, okay, that's it, which is giving me 100,000, 100,000 and 100. So 100,000 and 100. Then we go to the credit side as well, which is 40,500 plus 4,350 plus 16,000 plus 9,000 plus 250, which will give me again 150. And that's how you actually know it's correct, because the trial balance is actually supposed to balance. And just like that, you can close up your account. Then from there, we head on to this is 1C, question 1C. We head on to 1D. So 1D is requiring us to classify whether it's revenue expenditure or capital expenditure. So yeah, revenue expenditure or capital expenditure. So the first one, we have the sale of an old motor vehicle. This one is capital expenditure. Replacement of an engine in an existing van. This one is revenue expenditure, because when it comes to capital expenditure, it's like this one only comes in when you're acquiring a fixed asset. But here, there's nothing new you're actually acquiring. You're just replacing an engine in an already existing fixed asset, so it's not actually going to be capital, but it's actually going to be revenue expenditure. Then for the third one, which reads legal costs in acquisition of business premises, this is actually capital expenditure, because they are acquiring a premise, land. Capital expenditure. Then for the fourth one, money is spent on task for a new machine. This is also capital expenditure. Then for the fifth one, purchase of a vehicle for a salesman, which is also capital expenditure. Capital expenditure. Then second one, we go on now to question 2, which reads which of the following are personal, real or nominal accounts? So we have the first one, which is shown as still limited account. This one is actually personal account. Personal account. Then we head on to the third one, purchases returns account. So for the purchases returns account, this is a nominal account. Then freehold premises. Freehold premises, this is real account, it's an asset. Then for our fourth one, bank account, this one is also real account, it's an asset. Okay, that's how you actually get to answer question 2A. We go on to question 2B. So question 2B reads so this question reads Lucy, general dealers had the following motor expenses for the year ended 30th June 2022. On 1st January 2021 had a credit balance of 460, while the total 750 check were paid during the year for motor expenses. On 30th June 2022, there were an outstanding bill of 335 for motor expenses. So we're required prepare the motor expenses account for the year 30th June 2022 and clearly show the amount transferred to the profit and loss account. So let's just jump straight into the solving. So we start off first by preparing the tables. For the motor expenses account. So we start off first with the title. So the title is that we're going to get Louisa's General Dealers Motor Expenses account. Louis General Dealers Motor Expenses account. So you have a date column, details, then you have a debit column, a credit column. When we start, so on January 1st, we have the 1st of January 2021. So we had the balance and the credit balance, of 460. Then the following date that we put is on 30th of July 2021, and we had a total of 750 check. So I'll put bank with the balance, in fact 750. Then again I'll put 30th of July 2021. I'll put profit and loss. Then again 30th of July 2021, we'll put balance. So I forgot to put that this is actually balance brought forward, and this is balance carried down. And we draw these two lines. Then in the question we have again here saying that on 30th June the closing balance. So the 30th of June 2022. Balance brought down. We had an outstanding, meaning a credit balance, which will come here 335. You bring it here 335. Then you add up the total like 2, which will be 7. You add up and find the biggest amount. 7,050 plus 335 is the biggest, which you bring as here 7,385. 7,385. Then this side we just subtract this amount minus 460 that we have there, which is going to give us this. This will be our profit and loss, 6,925. And just like that, that's how you actually do this accounting and done. You can now close it up and head on to B. B, which reads, Immaculate College has always made a provision for bad debts at the rate of 3% of the debtors. On 1st January 2022, the amount brought forward from the previous year was 580. On 30th December 2022, their debtors stood as 15,700, and the usual rate for provision for bad debts is to be made. Required to prepare the provision for bad debts. So, preparing the provision for bad debts account. So we just put that. So we have a date column, date, then we have details, folio, debit, credit, and the title. You just put in the name of the college, Immaculate College, Immaculate College provision for bad debts account. So how we start it. Immaculate College has always made a provision for bad debts at the rate of 3% of their debtors. On 1st January, so on 1st January 2022, the amount brought forward, so balance brought forward, the amount brought forward was, for the previous year, was 580. So 580. The normal balance for a provision for bad debts account is always credit. This is why I've taken this amount to the credit side. So the next thing we put is on 31st December 2022, the data stood as 15,700 at the usual provision number. So we're going to put the date 31st December 2022. Then I can write it as check or bank, so I'll just put bank. Then what you do is this, you say this 15,700 multiply it by the percentage you've been given, divide it by 100, which is going to be 471. But this 471 will come in being our profit and loss. Profit and loss, which we say carried down so 471, which also come here as 471. Then from there, what we do is find the amount, the biggest figure, which is 580. And then from there, to actually make this balance, you will say 580 minus 471, which will give you 109 as your bank. And just like that, you're done. That's how you actually prepare the provision for bad debts. We now head on to the third one for question 2. So question 2 says, we have C. So C states, state 3 common causes of depreciation. So we can put depletion, time factors, or wear and tear. So these can be like some of the common causes for depreciation. And just like that, you have your 3 marks. Then we go on to B. So B reads for question 2D. Nkala Mine Limited bought a motor vehicle by check for 150,000 on 1st January 2019. The company's policy is to depreciate the vehicle at 20% per annum using reducing balance method. Charge full year depreciation in the year of purchase and no depreciation in the year of disposal. On 25th February 2021, the motor vehicle was sold for 86,000 by check. So I required to complete the table for 2 to 3 years. Complete the table for year 2 and 3. Prepare the motor vehicle disposal account. So we're going to start first by completing the table. So for the first year, this is how they actually find depreciation. Year 1, we actually go, the motor vehicle costed 150,000. Okay, so what you're going to say is this: 150,000, you multiply it by the policy, the depreciation, which is 20 over 100. 20% is 20 over 100. That's why I've done 20 over 100. We'll say 150 multiply by 20 divide by 100, which is going to give you 30,000 as your depreciation for year 1. And then to find your net book value, what you do is this: you say 150 minus the 30,000. So 150,000 minus 30,000, which is going to give us 1. This is the depreciation, or abbreviate it as DP, 120,000 as our net book value. Then this was just for year 1. We go on to year 2. Year 2, how you're actually going to find the depreciation is, say 120,000, you multiply it by 20 over 100 to get your depreciation. So times 20 divided by 100, which will give you 24,000. Then to get, this is your depreciation. To get your net book value, or you simply say 120,000 minus 24,000. So 120,000 minus 24, which will give you your net book value of 96,000. So this is the net book value, 96,000. So which is going to be 96,000. So it is going to be 96,000. So this is just for year 2. For year 3, this is what you actually do. You're going to say 96,000 times 20 over 100. Divided by 100, which is going to give you this. When you say 96,000 times 20 divided by 100, which is going to give you 19,200 as your depreciation. Then to find your net book value, you're going to say 96,000 minus 19,200, 6,000 minus 19,200, which is going to give you 76,800. And that's how you actually do it. So here we are just going to say 20%. Even here, going to just say 20%. The net book value for the second year was 120. For the second year was 96,000. 96,000. For the third year, the net book value was 76,800. And then the depreciation for the second year was 24,000. For the third year, depreciation was 19,200. And just like that, that's how you actually do it. We head on to prepare the motor vehicle account. So this is how you're going to prepare the motor vehicle account. We start off by drawing the table. So you say folio, details, debt, debit, credit. Then you start first the title. So you're going to say Mukana Mine motor vehicle account. So we're going to start with the balance. Sorry, the motor vehicle. The amount for the motor vehicle, which is actually 150,000. So that's the amount, which is actually 150,000. Then you actually write provision for depreciation. So, and then you write also bank as well. The provision for bad debt is actually 54,000, and then the bank is actually 86,000. Then you write profit and loss. So the profit and loss is actually 10,000. Then this is actually 150,000. 150,000. And that's how we prepare the motor vehicle account.